You are listening to The Vocal Technologist. Spoken tech for your ears.
You know, sometimes I feel like my brain is just perpetually lagging, like 3 weeks behind what's actually happening in the market.
Oh, tell me about it.
Trying to track crypto infrastructure, where the big money's going, these new token ideas. It's like reading a library during an earthquake. Just the sheer speed is wild.
It absolutely is. And that's really why we try and filter this stuff down. When you've got this much complexity, global regulation, new tech breakthroughs popping up constantly, you kind of have to figure out what actually matters.
Yeah.
So we've been digging into the recent material to see where the real money and the real innovation are moving right now, trying to find the signal.
Okay, so what are the big signals you're seeing? What's the focus for us today?
Yeah, so we're looking at three main shifts, I think. First, this undeniable institutional gold rush that's really happening. Second, frankly, bizarre rise of prediction markets suddenly becoming a top-tier financial thing.
Right.
And third, kind of the internal debates, the new ways projects are being built and launched, and the fights over how tokens should actually work.
Okay, let's definitely unpack that. Starting with the institutions, where the capital's really flowing. Bitcoin just smashed through to a new all-time high, $125,700?
Yep.
And that doesn't feel random. Analysts are calling it Uptober momentum, sure, but it's also these huge spot ETF inflows, like $7.7 billion just last week. That's serious conviction.
And it's systemic conviction now. We're past the point of institutions just dipping a toe in. Surveys show nearly 60% of them plan to boost their crypto holdings in the next year.
60%. Wow.
But here's the kicker for you listening. Those same investors, they expect their average crypto exposure to literally double within 3 years.
Double. Okay. Why? What are they saying?
It's transparency, it's speed, and frankly, it's the potential for massive cost savings compared to the old way of doing things.
And we're seeing that translate into like actual moves by traditional finance players, right? TradFi integrations. Coinbase, for example.
Exactly. Coinbase applying for that national trust company charter from the OCC.
Right. And they're clear they don't want to be a bank.
No, not a bank. It's purely about getting the right regulatory wrapper so they can be a better, more compliant bridge for institutions wanting to get into digital assets.
Makes sense. And Kraken's doing something similar, but maybe even more aggressively.
Oh, yeah. Kraken's strategy is definitely aggressive. They're integrating traditional futures from CME Group. We're talking oil, gold, S&P 500 futures right onto their crypto derivatives platform.
So blending the old and the new directly.
Pretty much positioning themselves as the place to go, fully compliant, offering everything in one spot, whether you're crypto native or coming from TradFi.
Right.
And all this while they're apparently eyeing a massive $20 billion IPO.
$20 billion.
Okay.
Now, here's something fascinating in the data you mentioned. We always talk about alt season for tokens, but the material suggests institutional money is actually creating a crypto equities alt season.
That's exactly it. Why deal with complex token custody right now if you can just buy stock in a crypto company?
The path of least resistance.
Always. Institutional capital loves familiar formats. They already know how to handle publicly traded stocks. The compliance is baked in. And look at the performance. Crypto-linked companies like Circle, up 368% year-to-date. Robinhood, up 299%.
And Bitcoin over the same time?
Just 31%. I mean, just 31% is still great, but it shows where that sophisticated money is flowing first.
Yeah.
It's finding the easiest on-ramp through these known entities.
Okay, speaking of accessible entities, let's shift gears to stablecoins. This is huge. We've crossed $200 billion in circulation.
Yeah, and that number isn't just about assets. It represents a massive geopolitical shift.
How so?
Fundamentally, it's about dollar access decoupling from the U.S. banking system. That $200 billion means potentially 8 billion people globally can hold dollars without needing permission from an American bank.
Right, that has huge implications.
Huge second-order effects. Suddenly, things like capital controls become way less effective if your citizens can just hold value in a stablecoin wallet. And think about remittances that estimated $150 billion extracted annually in fees.
Gone, or near zero, anyway.
Exactly. Flips to near zero cost. That directly helps developing economies.
And the mainstream is noticing. We're seeing big players move in now, right? Like Alipay.
Yeah, Alipay, a global payments giant, just launched a Euro stablecoin, BREUR, under the proper European ESMA framework. That's a major signal of regulatory acceptance, at least in Europe.
And it's not just consumer payments, it's corporate too. Brex.
Yep, Brex. First, global corporate card letting businesses make instant stablecoin payments. They're starting with USDC.
Yeah.
This isn't just crypto nerds anymore. It's legacy finance tools adopting this for regular business operations.
Okay, so that institutional appetite is clearly reshaping things. Which brings us to prediction markets. This feels like it came out of nowhere to suddenly be massive.
It does, doesn't it?
The validation is just stunning. Intercontinental Exchange, ICE, the parent company of the New York Stock Exchange, invested $2 billion cash into Polymarket at a reported $9 billion valuation.
I know. It's wild. That confirms it's not some niche crypto thing anymore. It's being treated like a major financial player.
And it's actually hurting existing players.
Oh, absolutely. It's becoming a real competitive threat. Remember when DraftKings and Flutter, the big sportsbooks, lost something like $7 billion in combined market cap?
Yeah, what triggered that?
It was right after Kalshi, a regulated prediction market, launched similar betting products. The economics are just better on these platforms. There's no house edge in the same way.
Right.
And skilled bettors aren't penalized or restricted like they often are on traditional sportsbooks. They can basically tap into that huge, like $84 billion offshore betting market that traditional finance could never really touch.
Okay, $9 billion valuation, $2 billion from the NYSE parent company. That's incredible pressure. But let's inject some skepticism. If it's so superior, what's the catch? What's the big risk hiding under the surface here? Finance isn't usually that simple.
That is the critical question, gets right to the market dynamics. The big problem, the Achilles heel for prediction markets, is something called adverse selection.
Okay, adverse selection. Explain that. Like, I don't have a PhD in finance.
Yeah.
And this liquidity death spiral thing you mentioned.
Right. So think of it like you're a market maker. You're the person putting up money, offering odds, facilitating trades on these yes-no outcomes.
Got it. I'm the house, essentially.
Kind of, but without the built-in edge of a casino. Now, adverse selection means that in these markets, you often have traders walking up to your table who have near-perfect information. They basically know the outcome already.
Oh, insiders?
Exactly, or just extremely well-informed traders. Because the market is binary and liquid, they can instantly push the price. Say something's trading at 50 cents, implying a 50-50 chance. An informed trader knows it's almost certainly going to happen, so they instantly buy it up, pushing the price to, say, 80 or 90 cents. They gap the price.
Okay, so they gap the price from 50 to 80 cents. What happens to me, the market maker?
You're left holding the bag. You just sold contracts at 50 cents that are now clearly worth much more, or bought contracts now worth much less. Your inventory is suddenly underwater. And crucially, unlike traditional markets where you might hedge on another exchange, there's no real way to hedge a one-off binary event like will X happen by date Y once an insider has moved the price based on knowing the answer.
Oh, so you just take the loss.
You just take a loss. This toxicity, this constant risk of being picked off by informed traders makes it incredibly difficult, maybe impossible long-term, for professional market makers to profit. So they leave.
And less liquidity means?
The market is even more susceptible to gapping by the next insider, which drives away even more liquidity. That's the death spiral. Less liquidity, more vulnerability, less liquidity. It's the fundamental risk under all that hype and valuation.
Okay, that is a massive challenge. It basically means the underlying tech and structure has to evolve super fast to even try and support these valuations. Which leads us nicely into our third area, this next-gen infrastructure and the focus on fixing incentives, starting with Base.
Yeah, Base is interesting. They're taking a really formal step towards decentralization now.
How so?
They're hiring a token and governance research specialist. This isn't just some junior role. It's high-level, strategic. The job is literally to design token goals and draft a Base constitution.
The Constitution. Wow.
Yeah, they've always used ETH for gas, right? But this signals they're seriously looking at launching their own native token to push towards real decentralization and community ownership. That's something a lot of big layer 2s are wrestling with.
Right, that long-term alignment problem. And while Base is thinking about its future structure, other projects are launching now, trying to fix problems from past launches, like that awful point farming meta. Tell us about this unicorn launch model from Virtuals.
Right. The unicorn model is it's a really interesting attempt to force long-term alignment and kill speculation games from day one. They've got a few key features.
Okay.
First, founders actually have to pay 100 virtual tokens just to create a launch. It's like a seriousness fee, a conviction barrier.
Stops frivolous projects, maybe? What else?
Second, they have this aggressive anti-sniper tax. It starts at 99% right at launch and then declines rapidly down to 1%.
99% tax. That sounds intense. What's the point?
It basically vaporizes the profit for any bot trying to instantly buy and dump the token for a quick flip. If you try it, you lose 99% of your capital. It filters out those purely short-term speculators.
Okay, so it protects the early price discovery. What's the main alignment mechanism, though?
This is the clever part, I think, performance-tied fundraising. A big chunk, 25% of the team's token supply, only starts distributing linearly after the project proves itself by reaching a $2 million fully diluted valuation.
And how does it prove that?
Through automated limit cells placed by the protocol itself, the market has to actually buy those tokens, demonstrating real demand and sustained value before the team gets fully paid. Their payout is directly tied to market validation, not just launch hype.
That is a big step towards aligning founders with actual long-term holders. Okay, let's talk pure tech performance. Scaling keeps getting better. We should probably mention the ZK Tech stuff on the Vocal Technologist today, right? The ZK Stack's Atlas upgrade sounds like a beast.
Oh, it really is. Atlas has this new high-performance sequencer. The benchmarks are showing over 15,000 transactions per second for standard stuff.
15,000 TPS.
Yeah, and potentially up to 43,000 for just simple ETH transfers. But maybe even more important is the cost reduction. They've dropped the proving costs down to like 0.0001 per standard token transfer.
Okay, so for you, the user, what does super high TPS and basically free proving actually mean?
It means the bottlenecks are just
Gone.
gone. You get what they're calling 1-second ZK finality? Yeah. Your transaction is cryptographically executed, settled, and provably finalized on the Ethereum mainnet almost instantly, faster than you can blink. That unlocks a whole new level of user experience for apps. Everything feels instantaneous.
And the DeFi architecture itself is changing to handle this kind of speed and efficiency too, of V4.
Exactly. AV4 is tackling a problem that's always plagued lending protocols. Liquidity fragmentation.
Explain that. What's the issue?
Well, in older versions like AVV3, if you wanted to create a new specialized lending market, maybe for tokenized real estate or something niche, you had to start from scratch. You had to attract your own pool of deposits, even though Avi already had tens of billions locked up elsewhere in the protocol.
Right, so every new market was its own little island.
Exactly. Fragmented. V4 changes that completely by separating the system into hubs for liquidity storage and spokes for market logic.
Hubs and spokes. Give me an analogy.
Okay, think of the hub as the giant central reservoir. It holds the deep, stable pools of major assets like ETH or USDC. The spokes are like specialized taps connected to that main reservoir.
Oh, yeah?
So if someone wants to launch a new market with unique rules, maybe different collateral types, they just build a spoke, the specialized logic, and that spoke instantly plugs into and draws liquidity from the massive existing hub.
Ah, so new markets get instant access to all of Avi's liquidity from day one.
Precisely. It turns the whole platform into one hyper-efficient operating system instead of a bunch of separate pools. Much more capital efficient.
Okay, finally, we have to touch on this token controversy stuff. Even big, successful projects are facing heat. Polygon, PyCoL specifically. Investors are not happy, citing like 46% underperformance year over year.
Yeah, this really highlights the struggle Layer 2s have with long-term incentives, especially when their native token isn't the core security asset that's still ETH, right?
So what's the proposed fix from these activist investors?
It's pretty drastic, but clear. They want Polygon to eliminate the persistent 2% annual inflation on the Polyol token.
Just get rid of it entirely.
Yeah. The argument is that this constant inflation creates sell pressure that holds the price back. They're saying you need to counteract that, maybe introduce token buybacks or burns to restore investor confidence and align incentives better. It's a fundamental debate about who pays for network growth and security.
Wow. Okay, so we've covered a ton. On one hand, you have this massive external validation, ICE putting billions into prediction markets, Kraken blending oil futures with crypto, serious institutional commitment.
Right.
But then internally, you have these really intense debates about structure and value, drafting constitutions for Base, fighting over inflation for Polygon, trying to build more aligned, more efficient systems from the ground up.
That convergence is exactly where the action is. You've got legacy power meeting this rapidly evolving tech. And for you, the listener, I think the key thing to grasp is how these things connect. The tech improvements like ZK Stack's crazy speed or a FAV4 fixing fragmentation, those are what enable the institutional confidence.
To build the foundation.
Exactly. And understanding these new alignment models like that unicorn launch structure, that's how you spot projects that might actually have long-term conviction baked in, not just hype.
It feels like every solution just raises a bigger, maybe more philosophical question, though.
It often does. Like, We talked about stablecoins becoming the world's permissionless dollar, right? But there's this growing idea of counter-sovereignty risk.
Counter-sovereignty risk.
Yeah. The idea is that even USD-backed stablecoins like USDC or USDT still tie users to the geopolitical whims and potential censorship of the US government, sanctions, freezes. It's the very thing crypto is trying to get away from.
So the stablecoin isn't the final destination.
Maybe not. The prediction some are making, like Shriram Cannon, is that as people really internalize this risk, the ultimate exit tech, the truly permissionless store of value you run to when things get dicey, won't actually be a USD stablecoin.
It'll be the base layer assets, like ETH and Bitcoin.
Exactly. The ones that are credibly decentralized and censorship resistant at their core. Which leaves a final question for you to think about. As finance keeps merging and these geopolitical lines get blurrier, what asset are you actually relying on as your ultimate, unshakable, permissionless store of value? Worth considering the implications.
Spoken Tech for your ears.